Welcome back to The Explainer. Today, we're diving into a total behemoth of the financial world. We're launching an investigative deep dive into the mechanics of one of the most powerful and, honestly, one of the most misunderstood financial institutions on the planet, BlackRock. We're going to look way past those flashy surface-level headlines, dig right into the data, and decode exactly how this massive machine operates.
Right out of the gate, we have to talk about the scale here because it is literally mind-boggling. $15.3 trillion. It's almost hard to wrap your head around a number that big. This represents the staggering amount of assets BlackRock reported under management at the end of the second quarter of 2026. It is a level of wealth that most of us will never, ever see, just quietly hiding inside the BlackRock ecosystem.
And the crazy thing, they are not slowing down. Over the 12 months leading up to that Q2 report, BlackRock pulled in another $868 billion in net inflows. I mean, in just the second quarter alone, they attracted $192 billion. Those are absolute monster numbers. It's so easy to look at that incredible momentum and just assume, well, BlackRock is winning, right? But as savvy investors, we've got to ask ourselves a tougher question. Does a giant financial company simply getting bigger automatically mean its stock is a smart buy?
And that is the central mystery we are unpacking today. Right now, with BlackRock trading around $1,156 a share, you are paying a very real premium for this company. So, are we buying one of the world's absolute strongest financial franchises at a fair price, or are we paying way too much for a company whose best growth is already baked in? To figure that out, we really have to break down what it is you're actually buying.
Okay, here's a crucial point, and I know a lot of you already know this, but it bears repeating. AUM, assets under management, is not revenue. It's a classic trap for beginner investors. BlackRock doesn't personally own $15.3 trillion. They just manage it for their clients. So their true economic engine, it relies entirely on the fees they charge, the investment products they create, their tech, and their ability to just keep that capital rolling in. A pro doesn't just stare at the total assets. They ask how much of that AUM is actually generating fees, and how safe are those fees long term?
To see where they're headed, we got to look at how they got here. BlackRock has spent decades basically reinventing itself. They started out as a pretty traditional asset manager, right? Then they aggressively expanded into ETFs with iShares, pushed into fixed income, institutional solutions, and eventually technology. And now? Now they are making a massive push into private markets. They aren't just trying to manage public market assets anymore. They're actually trying to build the underlying infrastructure for investing itself.
Which brings us to a total game changer that nobody should be ignoring. Aladdin. BlackRock is not just an asset manager. They are a massive financial technology provider. Aladdin sits right at the heart of the global investment ecosystem, handling risk management and analytics for huge institutional clients. And get this, in Q2 of 2026, their tech services and subscription revenue grew 13% year over year. That recurring subscription revenue is a totally different beast than traditional management fees, which, bounce around with the market. The real question is whether Aladdin can become their next absolutely bulletproof earnings stream.
But tech isn't their only major play right now. They are placing a massive bet on private markets. Now, private markets are super tempting because the fee opportunities are way higher and it diversifies the revenue. But higher revenue potential definitely doesn't mean lower risk. Public markets are familiar, they're highly liquid. Private markets, though, they are incredibly complex. We're talking totally different liquidity rules, really difficult valuations, and some serious execution risks. So are they brilliantly diversifying, or are they just making their business wildly complicated right at the exact moment investors are paying top dollar?
Well, let's look at the scoreboard and see what the income statement actually says. The Q2 financials are, frankly, powerhouse numbers. Revenue hit about $7.08 billion. That's a massive 31% jump year over year. Operating income surged 42%, and diluted earnings per share up 20%, landing at roughly $1.91 billion in quarterly earnings. I mean, those are undeniable blowout numbers. But you know us, we always have to look at what's hiding beneath the headline figures.
And this right here is exactly why we read the fine print. When you hear a company say earnings are growing, your first question should always be, which earnings? BlackRock's headline number, the one everybody quotes, is their adjusted diluted EPS, which came in at $13.91. But their standard GAAP EPS was actually lower. It was $12.19. As disciplined investors, we can't just casually throw around an EPS number without knowing exactly which standard we're looking at. But hey, whichever metric you prefer, earnings are clearly accelerating. So what are the actual shareholders getting out of this?
Well, they're getting a very specific kind of dividend test. BlackRock recently declared a quarterly dividend of $5.73 per share.
Now, if you annualize that against a share price of roughly $1,156, you're looking at a yield of about 1.98%. Now, hold on a second. A 2% yield isn't going to make a strict income investor jump out of their chair. So why do we care? Because the play here isn't today's yield. It's about how fast that payout can grow down the line. BlackRock isn't a high-yield stock. It's a high-quality compounder with massive long-term dividend growth potential.
But being a high-quality compounder brings us right back to our central problem. Quality like this does not come cheap. This is the valuation puzzle. At around $1,156 a share, BlackRock is trading at a trailing price-to-earnings multiple of about 27.7. The forward PE is roughly 20.6, and current market data puts the PEG ratio around 1.12. Now, a total beginner looks at 27 times earnings and just says, nope, that's too expensive. But a pro? A pro asks, what level of future earnings growth am I actually securing by paying that 27x multiple today?
And honestly, Wall Street is pretty split on that exact question. The general consensus out there is a buy, with an average target price hovering around $1,316. But look at this massive spread in the targets. On the low end, you've got analysts calling for $1,260 or $1,300, but on the high end, you're seeing targets of $1,450, and Morgan Stanley even slapped a $1,488 target on it. When the professionals disagree this wildly on a mega-cap stock, you really have to stop and ask, what underlying assumptions are driving this? Is it the Aladdin growth? Is it the private markets bet? Or is it just a disagreement on the valuation multiple itself?
All right, let's map out the arguments, starting with the bull case, which really leans on three simple but massive pillars. Pillar 1 is just sheer scale. $15.3 trillion in AUM creates an economic leverage that smaller guys literally cannot replicate. Pillar 2 is those flows. $868 billion in net inflows over 12 months proves that both retail and institutional money are still aggressively pouring into their platform. And Pillar 3, it's those multiple growth engines firing at once. It's not just management fees anymore. They've got ETFs, fixed income, Aladdin, and private markets. If all of those expand at the same time and the multiple holds steady, yeah, this stock could definitely run substantially higher. But we always have to play devil's advocate. Every bull case has hidden assumptions, right? So let's look at the bear case, or what I call the $15.3 trillion trap. Because BlackRock's business is fundamentally tied to capital markets, what happens if the markets just take a dive? AUM shrinks, and revenue falls right along with it. What if those massive inflows finally slow down? What if clients demand even lower fees, or that really complex private market bet takes way longer to pay off than expected? And most dangerously, what if that premium valuation multiple contracts just as earnings start to slow down? Listen, a fantastic company can still be a terrible investment if you buy it at the wrong price. And because of that reality, your takeaway totally depends on what kind of investor you actually are. Let's look at 4 different profiles. First, if you're a long-term quality investor focused on scale and tech, your verdict is probably to just watch for buying opportunities on any pullbacks. If you're a strict dividend investor hunting for yield, that modest 2% probably makes this a watch or a hold. Now, if you're a growth investor mesmerized by 31% revenue growth, you might see this as a buy or at least watch closely for a good entry. But if you're a strict value investor staring down a 27.7x multiple, your verdict is definitely to wait for a much better entry point.
Bringing it all together for our final framework, here is where things stand. The underlying business quality, absolute buy. The franchise is a juggernaut. Earnings momentum, we'll call that a buy or watch, just waiting to see if they can sustain this level of growth. The dividend profile is a hold, unless you're specifically playing the long game for dividend growth, but the valuation and the overall risk-reward setup at current prices, those are firmly a watch. When you're paying over $1,150 a share, the market is demanding absolutely flawless execution from BlackRock's management team. Which leaves us with one incredibly profound question to chew on. Look, if BlackRock really does turn $15.3 trillion into this unstoppable, diversified ecosystem of tech and private markets, then today's price might actually look like a total steal 10 years from now. But if the broader markets weaken and their growth just normalizes, this exact same premium valuation will be the anchor that drags the stock down. So the real debate isn't whether BlackRock is a good company. The data completely proves that it is. The real question you have to answer before putting a single dollar to work is, how much future growth are you paying for today? Thanks so much for joining me on this explainer, and I'll catch you guys next time as we decode the next great market mystery.